Hey OTA Options, this is Ruben, and I will be going over the Apple trade that I kind of shared with you guys yesterday. It is an Apple bull put. And so a few of you have asked me what is a bull put spread or what is a put spread, or just a vertical spread. And so essentially that just means that you're selling one leg and buying another to cover. So for example, if we look at Apple right now, so I got into this trade when Apple was right around like 160, 162, which is why you see here on this trade, my cover is 160. Now, for this trade, if I want to get stopped out at 160, which is where I bought my put where I would have had my stop loss. The reason being is the biggest risk with selling a put is obviously that it can go to zero. So essentially, if Apple is trading at 180 and it goes to zero when you sell the put, because you have an obligation to buy it, when you're selling it, your risk is essentially from current price to zero. So as you can obviously see, I'm selling a deep in the money put. So I'll go over that in just a second. However, like I said here, the biggest risk is if it goes from 180 to zero, which then means that times 100 shares equals $18,000, right? That's the maximum risk, and that is an enormous risk. However, with buying a put, which essentially I'm buying the insurance at 160, that is the maximum amount of money that I'll risk. So if it goes from 180 to zero at 160, that's where my insurance is covered, which is then a $2,000. It's 100 shares, so it's a $2,000 maximum loss. However, here's something to consider. Whenever you sell, so there's a few ways to do this, right? Everything has advantages and disadvantages. So whenever you sell a vertical put, usually a lot of people are told to sell it below demand. So essentially, if you're happy to control Apple at 162, then you can sell the put there and then buy the put to cover at, like, let's say 160, and you might receive a $400 or so credit. For that, or $100 or so credit. For that $100 credit, you are likely then risking $400. So the risk reward on that is kind of against you. Furthermore, if Apple goes from 162 to a million, you're essentially losing out on the entire move up. So the opportunity cost of selling a vertical put is that anything beyond the price of supply, or anything that goes north of where you sold the put, is missed opportunity or missed money. So the reason I sold the put at 210 is you have to consider whenever you sell a put, you are getting paid up front for the move. Usually in the US markets, that's the way it works. So to sell the 210 put, I received a credit for the 210 put. So what I essentially usually do for a trade like this, now mind you, this is not a buy, sell, or hold recommendation. I would not get into this trade right now. I've had to do it again. This is strictly for educational purposes only, and it's strictly for food for thought. It is a little bit more, in my opinion, it's actually simpler to understand, but it is different from how OTA teaches it. So keep that in mind. If that is working for you, I don't want to get in the way of that. This is just a different way of looking at it. This has a lot more variables. In a lot of ways, I feel like it's a lot less risk because you are essentially receiving a much larger credit for a move that is within the supply and demand range. That being said, with a 210 put, like if I were to sell the 210 put right now, so if I were to add if I were to add the legs, let's say I go 3 months out, because that's usually what I prefer, at minimum. So we are today at March, April, May, June. Let's just say June 21st. To sell that 210 credit, you're going to receive $30 worth of premium, which gives you a break even of right around current price. So 180, and then you get a 40 cents or so for free. So you're essentially controlling it more or less, more often than not, at current price. I like to go out 3 times further in time because I'd rather give myself more time to be right, and I'd rather give it more time to be in my favor. And then I will put the cover oftentimes where I would put my stop loss, because that's how I reduce not just my risk but my margin. However, you have to keep in mind, if I bought a 160 put, let's say it was $300, my break even for that is 163, and then let's say I receive a credit of $40 or what was it? $30, excuse me, for 210. That puts me a break even of current price 180, plus I got about 40 cents for free, and then the put I bought if it costs $3, for example, I would debit the 40 cents I got for free minus those $3, giving it a, or 300 for 100 shares, giving it a break even of about, 260 or so. So then I consider that to be my stop. And on an impulsive move down, or when it comes of, you know, how they would say into a demand zone at a, an explosive move down, as they say at OTA. It might be a couple of day trade. So even though I'm giving myself 3 months to be right, I might just hold it for 2 or 3 days. This trade in the last 2 days has made, like $2,000 or so dollars. So then I asked myself if I want to hold it to expiration for another, let's say 50% or 100%, or if I want to take my money and run, making, you know, 50 or 80% within a couple of days. So that's a margin question. That's how you want to calculate stop loss or profits, or however your trading plan is designed. So then, that's pretty much, so then the way I calculate that is break even credit minus, the put covered. So if it's, you know, 160, so then if the break even, or considering the put that I bought is $2.60, and 260 is my risk for the move. Cause it's, I take my cover, and then depending on whether I want to hold it into expiration or not, I'll consider a theta in that, but that's really a last step process. And so, then I'm controlling it essentially for my break even, as long as my stop is where I would want it to be, of, let's say 160, or so, like, let's say 162, you know, 60 or 162.40, excuse me. To then my maximum gain, which is 210. So I hope that was helpful for you guys. I can go over an example maybe a little later. Again, this is not a buy, sell, or hold recommendation. This is not to change the way you already think about options or the way you trade them. This is simply food for thought. This implies a lot more risk. It has a lot more to do with break-evens, understanding supply and demand, understanding price action. I know I talked to you guys about the wicks in another video, and as you can see here, like the 4 hours playing really well. A lot of times I'll take partial profit at supply. I noted on the video that I took a partial profit yesterday towards the end of the day, so I sold just the long put, but I held on to the shorter put. So long as one of my, as long as I'm never naked with any of the puts, I am fine. So sometimes take an incremental profit thereafter, whenever it hits supply on, like, let's say the 1 minute or the 15 minute, depending on the time frame. I never take trades off of the 1 minute, but I use the 1 minute to get in and out, so I can front run the rest of the trades, or the traders out there. And then I will usually do some sort of retest on the, oftentimes 4 minute, 15 minute, or 4 hour, whatever they're after. So, with that being said, guys, I hope that was helpful again, and let me know in the comments if you would like to go over more of these examples. Again, this is a little bit, in a lot of ways, it's simpler to calculate, but it can be a lot more risky if you don't know what you're doing, or if you're not paying attention to, like, open interest or risk of being assigned and so on and so forth. But other than that, you're covered pretty well. Just don't over leverage. Again, this is simply food for thought, based on supply and demand. I hope you guys found this helpful. Have a fantastic rest of your day. One final note, guys, and this is why I keep saying that it's important to know and have your end goal in mind, is because depending on what you're trying to accomplish, if you're a wealth student, this is actually really important for you, is opportunity cost. Because if you're missing, here, I'll just read this to you guys. So despite being so common, corrections are impossible to predict. At least over the long run. According to an analyst from JP Morgan Asset Management, if an investor were to have held an S&P 500 index fund between January 1st, 1995 and December 31st, 2014, they would have netted a cumulative return of 555%, or 9.9% a year. Mind you, that includes holding through both the dot-com bubble and the Great Recession. But if they had just missed 10 best trading days over this 20-year period of time, they would have cut their gains in half, or more than half, to 191%, which means that depending on your goals, if you're a wealth student or you're trying to build your wealth bucket, you cannot afford to miss up moves. And that would have to be incorporated to your trading strategy if you are primarily going long, you're buying and holding. And that is why, knowing your opportunity cost and being mindful of that when you're going into a trading style or scenario is so important. And that's why I keep saying, all asset integration is so important because I do use all asset mastermind and I incorporate the different assets for different things. I do a lot of hedging. I integrate options and futures and stock with Forex and so on and so forth. And I make them work seamlessly together to take in different positions depending on the goal that I'm trying to accomplish. Using them individually or just having an all access to stocks, bonds, futures, Forex options. If they're all 3-to-1 or so on and so forth, then there's not much of an opportunity cost of taking one versus another. And that's why the integration of all the assets are so important. So you can kind of layer them with each other and make an end goal kind of style depending on that. So I hope that was helpful, guys. Let me know in the comments below. And have a fantastic rest of your trading day. Happy trading day.